Intel Corporation, ticker INTC, is currently trading at $27.75 and is down by 4.90% since the last 6 months. If we have a look at the maximum graph, we can see that the price fell from $45 in 2022 to $27 in 2023. Now, if we have a look back at the 6-month graph, we can see that in February 16th, there has been a large decline in the stock price, and this was due to Intel cutting its dividends by more than 66%. Now, if we have a look here, we can see that Intel is currently trading at a really low price compared to what it has been trading over the last 5 years. Therefore, today I want to evaluate Intel and see if it might be trading below its intrinsic value. To do this, we'll jump over to my stock analysis tool, where we will apply the 9-player analysis and find the intrinsic value using the Grams formula revised, discount cash flow model, multiples valuation model, and the dividend discount model. We will then find the future value of your investment within the next 10 years. Now let's jump to our statistics page, and here we can see that the current dividend yield of Intel is at 1.79% and the cash per share is at $0.125 per share per quarter. We can further see that the analyst's target price for next year is at $27.37, which is slightly lower than the current price of the stock, which is quite concerning. Here on the left, we can see that the income of Intel has been decreasing from 2021 to 2022, as well as the free cash flow, which has decreased by more than 200%. Now let's jump to our 9-player analysis, where we'll analyze the potential of Intel Corporation. First one, the 5-year P ratio to be below 22.5. Intel has its P ratio at 10.75, which is a good P ratio. After that, we want the 5-year profit margin to be above 10%. Intel has its profit margin at 25.09%, so that's a good thing as well. But next, we can see that the total revenue and net income have not been increasing over the last 5 years and instead have been decreasing, and net income has been decreasing by quite a bit. So that is actually quite a red flag. Next, we want there to be a decrease in shares outstanding, and as we can see, Intel has been issuing out more shares over the last year, which to me is a red flag because I believe that they should be buying back their shares instead of issuing out new ones, as they are currently trading at a really low price compared to its historical value. After that, we want the long-term liabilities over the 5-year free cash flow to be lower than 5. Now, this means that the company has the capabilities to cover its long-term liabilities with its historical 5-year free cash flow. We ideally want this ratio to be below 1, as that means that the firm is capable of covering its long-term liabilities with its historical free cash flow fully. If this value is above 5, it means that the company has 5 times the debt than what it can generate in 5-year free cash flow. Next, we want there to be an increase in free cash flow over the last 5 years, and as we can see, similarly to revenue and net income, this has been decreasing as well. After that, we want the price to free cash flow to be below 20, which it is. And finally, we want there to be consecutive dividend growth. Now, take into account that to this value, I did not add the recent dividend cut, as I do believe that the company will recover quite swiftly, and within the next 5 to 6 years, the dividends will be back up to which they have been before the dividend cut. Now we can see that even though Intel is a well-established company with a market cap more than $100 billion, it has been struggling quite a bit over the last few years, and it has been struggling mainly in the revenue growth and the net income growth areas. But now let's jump to our intrinsic value calculator and find the intrinsic value of Intel using the Grams formula revised. We plugged in the earnings per share of Intel and the 5-year growth estimate, which is at negative 25%, to get an intrinsic value of $26.49, which is 5% lower to the current trading price. Now let's look at the discount cash flow model. Here I plugged in the free cash flow of the last 10 years and calculated the average growth rate of 6.53%. I then combined that with the analyst growth rate projections of negative 25% to get a growth rate of 0.62%. I then used this growth rate to calculate the future free cash flow over the next 10 years, and I calculated the present value of this future free cash flow using the discount rate, which is at 8%. I then summed up this future free cash flow and added any cash and cash equivalents and subtracted any debt to get an equity value of $148 billion. I divided that by the shares outstanding and got an intrinsic value of $35.92. Let's have a look at the next valuation model, which is the multiples valuation model. This model is based on comparing companies that are structured in a similar way to Intel Corporation. For this valuation, I chose these 3 companies which operate in a similar tech niche as Intel. I took their stock prices and divided by their earnings per share to get their PE ratios. I then averaged out these P ratio to get a P ratio of 17 and 0.3. I multiplied this by the earnings per share of Intel and got an intrinsic value of $34.06, which is higher than the current trading price. Let's move to our final valuation, which is a dividend discount valuation. I plugged in the dividend payout over the last 5 years and calculated the average growth rate of 1.17%. I then used that to calculate the next year's dividend of 1.21. Now, take into account that these two values aren't purely based on the calculations done through these tables displayed above, due to the reasons I explained during the 9-pillar analysis. Now, I use these two values and the WACC to calculate the intrinsic value of $18.04, which is lower than the current trading price. Now, if we scroll down, we can see that here we have our final stock valuation, where we average out the grams valuation, the multiples valuation, the discounted cash flow valuation, and the DDM valuation to get an ultimate intrinsic value of $26.82, which is currently 4% lower than the current trading price. Now, due to the 9-pillar analysis and the fact that we found that there is no revenue growth or no net income growth or no increasing free cash flow, I want a higher safety margin. So I want a safety margin of about 20%, which will give me an acceptable price of $21.45. Now, if you wanted to take a little bit more risk, you could plug in a safety margin of only 10%, and in that case you would be buying at $24. Now, before we finish this analysis, I want to have a quick look at the future value of investment model, which is based on predicting the stock price growth over the next 10 years based on the historical price. As you can see, I plugged in the historical price growth over the last 20 years, as well as the dividend growth and the current dividend cash per share per year. Let's say we want to invest €1,000 at this time. This would mean that by the end of 10 years, you would have $1,692. But if you account for inflation rate and calculate the present value of your investment, you would only have $1,348. Now, say you were to reinvest your dividends every single year, this would leave you with a present value of $1,718, which is an increase of 71.81%, and would leave you with a net income of $718. Now, say we were to invest $250 every single year. Although this would push your percentage increase down, it would raise the present value of your invested cash, and it would also raise your net income to $1,255. If you want to watch some more of my valuations, they're here on the screen right now. If you enjoyed the video, make sure to leave a like and let me know down in the comments which stock you would like me to evaluate next. I also upload 2 to 3 times a week, so if you don't want to miss out on any stock valuations, make sure to subscribe, as that would really help me out.